Marshall Society event, we're very grateful to be joined today by Barry Eichengreen. He's a professor at the University of California at Berkeley, and he specializes in the international monetary and financial system. He's had a long and distinguished career. He's worked as a policy advisor for the IMF and also president for the Economic History Association. He's written numerous books, including Exorbitant Privilege. He's going to be speaking today about the dollar and its discontents, and we should have some time for questions at the end, so please submit those in the live chat as we go along. So over to you, Professor Eichengreen.
Thank you very much. So it's nice to be back in Cambridge. Metaphorically, anyway, about 3 or 4 years ago, I spent a year as the visiting Pitt professor at Gonville and Keyes and in the economics faculty. So I have fond memories of Cambridge, which this event enables me to revisit. So I'm going to talk about prospects for the dollar for a couple of reasons. Number one, because it provides, I think, an interesting historical and current eventsy perspective on broader issues having to do with changes in the global monetary and financial system. And secondly, because there's an awful lot of chatter at the moment about whether the dollar is doomed. I pick up my Financial Times every morning and I see another article about the impending 20% fall in the dollar, or about how the dollar is about to be supplanted as the leading global currency by the Chinese renminbi, or a couple of days ago, how for the first time in history, the euro accounted for more cross-border transactions through SWIFT than did the dollar. So there is a lot of chatter out there, and I think it's useful to try to think about it a bit more deeply and put it in perspective. My point is going to be that all this doom and gloom about the dollar is a bit overdone. I'm reminded of this passage from The Importance of Being Earnest, when Cicely was instructed to read her political economy, but to omit the chapter on currencies as being somewhat too sensational. So I will similarly argue that a lot of this pessimism about the dollar is similarly somewhat too sensational. I am going to use as my foil, if you will, this recent column in Project Syndicate by Stephen Roach, renowned, well-known economist, formerly Morgan Stanley, now a professor at Yale University, who writes about, evidently, the vice tightening on the dollar, where he argues, I continue to expect this broad dollar index, meaning the dollar exchange rate against a broad basket of other national currencies, to plunge by as much as 35% by the end of 2021, reflecting three considerations. Number one, rapid deterioration in US macroeconomic imbalances. Number two, the ascendancy of the euro and the Chinese renminbi as viable alternatives. And number three, the end of that special aura of American exceptionalism that has given the dollar Teflon-like resilience for most of the post-World War II era. I think there are some things wrong with this forecast of what comes next and diagnosis of why. Putting it more bluntly, I think this is wrong on many grounds, to wit, the fact that this argument is based on the familiar twin deficit story that many people were telling just prior to the global financial crisis. So the argument goes like this, and here again, I'm quoting from Roach's column. With personal savings in the United States likely to recede sharply in the months ahead, and the federal budget deficit exploding, the plunge in domestic saving in the second quarter of 2020 is only a hint of what lies ahead. And that plunge in domestic saving will trigger a collapse in the US current account deficit. Lacking saving and wanting to invest and grow, the United States must import surplus saving from abroad and run massive external deficits to attract foreign capital. The implication being that the United States will be able to attract that foreign capital to finance its massive current account deficit only by making its assets more attractive to foreign investors. And the way we in the US do that is by depreciating the dollar, making investing in the US cheaper for residents of other parts of the world. So the causal chain runs from the budget deficit to the current account deficit to the need to import savings into the United States from abroad to the plunge in the dollar. There's only one problem, namely, we know from history that the deficits are not twins. The budget deficit and the current account deficit do not move together in lockstep. They do not move together very much at all. So I showed them the two deficits to you here since 1979 or so. If you stare really hard, you might pick out a weak positive correlation on balance, but you've got to stare at this figure pretty hard to find them. And there are obvious reasons why the deficits are not twins. The federal government is dissaving in the United States big time, but we have to think about private saving as well. And we have to think about what happens to investment. So this twin deficit logic, as I said before, was invoked widely. I wrote about it, truth be known, in a book called Global Imbalances and the Lessons of Bretton Woods. A lot of people who saw the budget deficit in the US widen in the run-up to the global financial crisis thought the dollar would crash, but it never happened. In fact, the opposite happened following the onset of the crisis. So that's a reminder that other things besides the exchange rate affect the demand for dollar-denominated assets. Foreigners will finance our current account deficit in the United States if, in fact, we have one, conceivably at the currently prevailing exchange rate, if they find the safety of those dollar assets, the liquidity of those dollar assets, the return on those dollar assets as being attractive. So let me unpack, as I write at the bottom, a few of these ideas. The first question is, what will happen to private or household saving in the United States post-pandemic and crisis? Will private savings rates go back to where they were before the crisis? I would argue history suggests not. Households have been reminded of the inadequacy of their precautionary saving, that they didn't have enough money in the bank to put food on the table for more than a few weeks. So they're going to increase their precautionary saving permanently. We saw that kind of behavior after the slump, after the Great Depression of the 1930s, the greatest generation, the people who came of age during and after World War II, had famously conservative investment behavior and saved big time. I have a colleague at Berkeley, Ulrike Malmandier, who's looked similarly at how recessions affect risk-taking and saving in this quarterly Journal of Economics article, for example. So that historical evidence and Ulrike's more recent evidence suggest that there may be more private saving going forward, and that additional private saving will offset the additional public dissaving. So even if the government is running budget deficits, the United States will not necessarily run commensurately large current account deficits. The US savings rate jumped up during the first lockdown when people couldn't go to the mall, they couldn't go to the store. It's back down a bit, but the most recent figures I've seen, I believe these are the most recent figures we now have for US savings in August of this year, still show the savings rate as very considerably elevated by the country's earlier historical standards. And that seems to be what financial markets are assuming as well. If you thought that households were going to resume spending big time and the government was going to continue spending big time, there would be more demand chasing the same supply, and that would create inflation. But if you look 10 years into the future, financial markets look 10 years into the future. You can look at the difference in the pricing of US Treasury bonds that are indexed for inflation and that are not indexed for inflation, and back out expectations of inflation going 10 years ahead. They remain subdued. Financial market participants don't expect inflation above 2% for the remainder of the decade. So they evidently agree with me that private spending will remain relatively subdued so that the additional public spending will not translate into inflation. What will happen to investment in the meantime, even if Americans, the government and the private sector are saving less, we may be investing less as well. So I think as long as the course of the pandemic is uncertain, and as long as we remain uncertain about how tastes and behavior may change post-pandemic, will people start going out to restaurants again? Will they go back to the pub? Will business travel recover? Should construction companies be investing in city center office space or suburban housing? I don't think we really know the answers to those questions yet. And as long as those answers remain uncertain, there's option value to waiting, to not investing until the picture grows clearer. So savings may be lower, but investment may be lower as well. And again, the budget deficit run by the federal government need not translate into a current account deficit. Reminding you that the current account deficit is the difference between national investment and national saving. This is an argument for why both might fall post-pandemic. And there are further uncertainties affecting investment. The course of investment will depend on economic policy, and economic policy in the United States going forward is uncertain, given that we don't know which party will have majority control of the Senate and so forth. Let me skip this one in the interest of time. So I would argue, even if saving and investment revert to their old normals, even if they go back to where they were pre-pandemic, even if the US continues running substantial budget deficits indefinitely, as seems fairly likely, again, it seems to me it's not at all clear that the US government will have trouble financing its deficits at something close to current interest rates and current exchange rates. There was a strong demand for safe assets prior to the slump, where US Treasury bonds are the safe asset par excellence. And you could see that fact. You could see that in the fact that US Treasury bond rates were at rock bottom levels, down on the order of 1% for 30-year treasuries, even before the crisis. So the question being, why should that be significantly different after the crisis? Another way of thinking about this is that the pandemic occurs against the backdrop of what has been a secular rise in savings globally relative to investment globally. Saving was already high relative to investment prior to the crisis. And we know this from the fact that interest rates had been trending downward for the better part of 3 decades, as I show you on the right of this slide. Interest rates had to fall in order to equate the abundant supply of saving with the less than abundant demand for funds for purposes of investment. Something that I think reflected in part a shift in economic activity in less capital intensive directions, away from capital intensive heavy manufacturing toward tech. So the firms nearby to me in Silicon Valley generate a lot of profits and are responsible for a lot of stock market capitalization, but they don't engage in a lot of physical investment. And we see all the time other activities moving online in toward less in capital intensive modes, instead of having showrooms for their motor vehicles. Auto companies use their own or other online platforms in order to sell cars. So you don't need to build or rent a showroom in order to be in the motor vehicle retailing business. So I think that again is an indication that physical investment, the demand for funds may not be all that strong post-pandemic. One last observation on about this. I think there is one valid point to keep in mind here, which has to do with the COVID jab, as the FT put it. We know that the dollar benefits whenever uncertainty spikes, that the US Treasury bond market is the single largest and most liquid financial market in the world. And when uncertainty spikes, there's nothing that investors value more than liquidity, more than the ability to get their hands on their money when they need it. So if the rollout of these 3 vaccines now mean that uncertainty is going to decline, then the flight to the dollar, the flight to safety and liquidity is likely to diminish. So I don't disagree with this logic, but I disagree with articles like the one I show you here on the right, which suggests that this could lead to a 20% fall in the dollar in short order. I think that kind of number is oversold, way too large, and that's a one-time adjustment, not a ongoing secular decline in the value and the attractiveness of the dollar. So everything I've said so far is about the United States. Well, let me, before I get away from that, let me say a couple of additional things. Before you get all excited about the vaccine and about its implications, among other things, for the dollar, I think there's still the question of whether the vaccine will really make a first order difference for the global risk environment. It'll make a first order difference if people actually take it, but there are questions about whether that's the case. There's been mixed messaging by politicians, as you know. There are questions about the safety of these early vaccines. There has been another secular rise over a period of decades in anti-vax sentiment in a surprising number of different places, like France and Germany, for example. And finally, there are the effects on attitudes toward vaccination of the epidemic itself. So I reproduce on the slide here on the right a recent National Bureau of Economic Research working paper with a couple of co-authors, where we used a Wellcome Trust survey of respondents in a wide variety of different countries, where they were asked, are vaccines safe? Would you vaccinate your own children? Questions along those lines. And we found that people who had been exposed to an epidemic in the past were more skeptical than otherwise comparable folks about the efficacy and safety of vaccination. I think epidemic exposure and the bungling efforts of governments to deal with the consequences of epidemics give rise to a lack of trust in governments, lack of trust in experts, lack of trust in scientists, all of which we document in the paper, and lack of trust in vaccination. So there is a real reason to worry about the possibility that people are not going to get vaccinated. I should mention one more thing, which is we find that those changes in attitude owing to epidemic exposure. In the paper, we look at 34 epidemics affecting 130 countries, stretching back to 1970. But we find that the folks whose attitudes are strongly affected negatively by epidemic exposure are members of what today we call Generation Z. So I'm speaking to you, the Marshall Society, that it's people in their impressionable years, 18 to 25, when attitudes about politics and society seem to be durably formed. That's what psychologists and neurologists tell us. Those are the people whose attitudes are most strongly affected, making me think that messaging around vaccination ought to be tailored to Generation Z. So here I show you, just for your interest, the global map from Wellcome Trust 2018 of attitudes toward vaccination. It's interesting to stare at and see some of the surprising anomalies here. The French evidently really don't trust vaccination. There you have it. So this brings me to the second part of Roach's argument, which had to do with the ascendancy of the euro and the renminbi as viable alternatives. I think Stephen would acknowledge that at the moment, neither the euro nor the renminbi is a viable and attractive alternative to the dollar for central bank reserve managers and corporate treasurers and others doing international business. But there's a suggestion here, an assertion here, that that's going to change quickly, and it'll be straightforward for the euro area and China to position their currencies as serious rivals, viable alternatives to the dollar, in response to which I would say not so fast. To be clear, I'm a fan of the euro. I've been writing about the euro since 1990 or so. And I wrote an article way back in 2008 about how the euro was here to stay, and all these stories about how someone turned out to be Greece. The argument was going to abandon the euro. Wrote an article about how that would not and could not come to pass. So I am convinced the euro is here to stay, but the fact of the matter is that the euro punches below its weight, and it's been losing ground as an international currency, not gaining ground since the early 2000s. The European Central Bank publishes an annual report each summer on the international role of the euro. They construct a composite indicator of how important that international role is. Here you see the composite indicator put together in two different ways, and it's been going down, down, down fairly steadily since the early 2000s. So maybe you would be inclined to argue that the euro is now beginning to gain ground again because those indicators have turned up in recent years. But by any measure, pretty much any measure, pick your favorite measure, the euro still lags far behind the dollar. And it plays an international role mainly in Europe's own neighborhood, that Central and Eastern European countries that are not in the euro area invoice their trade in euros or issue bonds denominated in euros. It's a regional currency still, in other words, not yet a true global currency. So there are obstacles to the euro becoming a viable alternative to the dollar. Europe has to grow its platform. It has to grow its domestic and cross-border transactions. And it wasn't doing so well relative to the United States before the pandemic. It's not clear that it will do as well as the United States after the pandemic. Some European countries are going to come out of the crisis very, very heavily indebted, absolutely and relative to the United States, both. And if you believe that economies are going to have to be radically restructured after the pandemic, which is what I think, then you don't want to freeze employment in amber. You don't want to keep people attached to their current jobs forever, which is what a lot of European countries have done through their job maintenance schemes. In the United States, we believe in creative destruction. We're really good at the destruction part. So people are not being subsidized to remain with their current employer to anywhere near the same extent as in most European countries. So workers are going to move faster into new activities. All those flight attendants are going to become home healthcare workers or something more rapidly in the US than in Germany. So I think there's a real question of whether Europe will be able to grow the platform as successfully as the US going forward. The ECB was late to acknowledge that it needs to act as a lender and liquidity provider of last resort, something that the Fed has done for many years now. The Fed provides dollars on demand to foreign central banks around the world. It operates dollar swap arrangements with dozens of central banks around the world. Last time I looked, the European Central Bank had exactly 4 dollar swap lines with Romania, Bulgaria, Denmark, and Croatia, hardly indicative of the kind of swap network that a first-class global currency would display. And there is a shortage of safe euro assets. I think I have a couple of tables on that, but let me just make the point verbally. Treasury bond markets in Europe are smaller than the US Treasury bond market. A lot of those European Treasury bonds have been hoovered up by the European Central Bank as part of its quantitative easing, et cetera. And a lot of the remainder has to be held as reserves or as a form of capital by Europe's own banks. So that leaves very few safe AAA euro assets available to central banks and corporate treasurers and others outside the euro area itself. So there, as I said, there are a couple of tables here which shows you the magnitudes, where at the on the bottom row of the table show you that there are a lot of US Treasury bonds out there, but the total stock of safe Euro assets, AAA European Treasury bonds is much less. And then when you subtract off those held by the ECB and commercial banks, the European supply becomes smaller still. Europe can address those problems. It can solve them over time, but my point here is that solving them will take time, that Europe can develop its securities markets, its bond markets. That's what Capital Markets Union is supposed to do, but that will take time. It can issue European Union bonds like the recovery 850 billion euro recovery fund currently on offer, but that's small potatoes compared to the 10 trillion euro plus in reserves that central banks and sovereign wealth funds around the world hold. Maybe that 850 billion euro recovery fund is Europe's Hamiltonian moment, or maybe not, but that 850 billion will have to be increased by an order of magnitude in order to really make a difference. And we know that the Frugal Four and others are opposed to moving down that road. The renminbi similarly punches below its weight. So that China's currency accounts for only 1% of global foreign exchange reserves, where the dollar accounts for on the order of 60% of global foreign exchange reserves. So 60% versus 1% is a big difference. China has been working hard at trying to advance the process of renminbi internationalization and encourage its Belt and Road partners, among others, to hold more renminbi as reserves. Here's the progress to date from, 1.1 to 2.1% of total reserves over a period of 4 years. Not overwhelmingly impressive. If you look at cross-border payments through SWIFT, the Society for Worldwide Interbank Financial Transfers, the dollar accounts for 40%. There's more recent data now, as I told you, and the euro has slightly overtaken the dollar by this metric, but China's share has not budged. It's still down there below 2% of total cross-border payments, where again, the United States is up there closer to 40%. Lots of things have been tried. The People's Bank of China has lots of renminbi swaps with foreign central banks. One of the big four Chinese banks has made an official clearing bank to help settle transactions in renminbi in virtually every global financial center. One of them has been made an official clearing bank in London. China has encouraged its Belt and Road partners to hold and use renminbi, but none of this seems to make much of a difference. The question being why? It could be that China simply made a late start on the process, and it's about to catch up rapidly. Alternatively, it could be something more fundamental. Whenever I go to China and talk about these issues, because of the pandemic, it's been a while now. Nonetheless, I talk about them over Zoom, and I continue to make this point, namely that every true international and reserve currency in history has been the currency of a political republic or democracy. So that's true of the United States at the moment. It was true of Britain before the US. It was true of the Guilder and the Dutch Republic. It was true of the Republican city-states of Venice, as I show you here, Genoa, Florence. And I think that reflects the fact that investors value the presence of checks and balances, restraints on arbitrary action by the executive. Corporate treasurers and foreign central bank reserve managers are not going to feel comfortable parking a significant share of their portfolios in China and its currency, absent checks on arbitrary action by the executive. So this is, I know it's the People's Republic of China, but from this point of view, China has been moving in the wrong direction toward more centralization of power and more power in the hands of the executive rather than less. It needs to do things like make the central bank, People's Bank of China, independent of the political system, and it shows no signs of going there. Is a Chinese central bank digital currency a game changer? Some people say yes. China almost certainly will be the first country to roll out a central bank digital currency. How much difference will that make? It'll slightly reduce the cost of doing cross-border transactions using China's currency if it is digital, but I think there are other concerns as well. So I show you here a graphic from a Korean website, which Yonghap conducted a survey of Korean merchants and asked them basically two questions. Would you accept Alipay from your Chinese customers, from Chinese tourists when they patronize your shop? And the typical Korean merchant said, yes, sure, we're used to that. Then they were asked, would you accept a Chinese central bank digital currency? And the answer was maybe, but would that central bank digital currency contain a backdoor? Would it be secure? Would transactions in it be anonymous? Or would the Chinese government be surveilling my transactions as well as those of the Chinese tourists? So I think, again, these security concerns, which are related to the centralization of power and the absence of checks and balances that I talked about before, suggest that a central bank digital currency would not significantly modify the story that I've been telling you. So to give Roach a little bit of credit, this is going to be my last substantive point, and then I'll conclude. I would agree that there is a scenario in which the Teflon-like resilience that the US has enjoyed for most of the post-World War II era may be coming to a close. I've been arguing that political checks and balances matter to international investors and that they are important for the maintenance of international currency status. From that point of view, the last 4 years have not been kind to the United States and the dollar. I think people have less confidence globally about the strength and resilience and integrity of US political institutions today than they did 4 years ago. And that may at least modestly hasten diversification away from the dollar in favor of alternatives. The same applies to US alliances and America's commitment to multilateral institutions. I've done some work with other co-authors looking at geopolitical alliances and international currency status. And what you can see in the data is that central banks and governments hold as reserves the currencies of their trusted alliance partners. If you have a defense alliance with the United States, you hold the dollar to a greater extent than otherwise. Historically, Japan and South Korea, which rely on the United States for their nuclear umbrella, hold more dollars than their trade with and investment in the United States would lead you to predict. And maybe President Biden will repair US alliances, but they undoubtedly have been significantly frayed by the events of the last 4 years. So I show you here the article on currency reserves with Arno Mell and Libya Chitu, where we document those patterns. So to give Stephen Roach credit where credit is due, he certainly has a point here. So I kind of talked about the vaccine and COVID. There's also the fact that we in the US are now suffering an unprecedentedly bad COVID winter, which I think implications for the dollar we will have to see. So to conclude, I think that alternatives to dollar dominance ultimately will develop. The United States by itself, all alone, cannot continue to provide safe and liquid assets to the entire world indefinitely, for the simple reason that the US is going to account for a declining share of global GDP and financial assets over time as emerging markets continue to emerge and gradually close the per capita income gap relative to the US. But the thrust of my argument is that the development of these alternatives will take time, a very considerable period of time, because of the formidable economic, financial, and above all, political obstacles to putting in place the entire range of prerequisites for international currency status. So on that note, thank you. I'm happy to take some questions.
Yes, thank you very much. That was very interesting. And we've got quite a few questions coming in, actually. So hopefully we'll be able to get through as many as possible. So first of all, a question from me. In Exorbitant Privilege, I think you can correct me if I'm wrong, you said that when government debt gets to around 75% in the US, that becomes a problem for the US dollar. So now that it's at 100%, do you think that government debt is going to be a problem for the US dollar going forward?
So I'm happy to contradict myself circa 2010. I think we've learned some things since then. We've learned that interest rates are going to remain remarkably low now for an extended period, not something that most of us, including me, had taken on board 10 years ago. So the debt to GDP ratio today in the United States is double what it was before the global financial crisis. But our debt service as a share of GDP is lower than it was back then, because interest rates today are so much lower than they were before the global financial crisis. So I think you have to revise your outlook of what's sustainable given changes in current conditions. So that, your question together with my answer points to the important issue going forward, which is whether interest rates will remain that low for an extended period. So one answer would be, doesn't matter, because debt managers can lock in those low interest rates today. They can exchange the shorter term bonds that are out there for 30-year or 50-year bonds and lock in those very low interest rates, because the markets seem to have an unlimited appetite at the moment for long-term US Treasury bonds at currently prevailing interest rates. Another answer would be that maybe reserve managers are not that smart, they won't do it, and we do have to worry about interest rates going up. To which I would answer, Yeah, at that point, we will have to make some difficult choices. And if continued political polarization in the United States prevents us from making sensible choices, that's the point where I would begin to worry about the dollar. But I'm not worried yet because I don't see interest rates spiking anytime soon. And I'm hopeful that the polarization that we saw in the United States for the last 4 years will not last indefinitely.
Well, that brings us on quite well to a question from our audience. How much influence do you think Joe Biden and Janet Yellen will be able to exert on the economy, given the absence probably of a Democratic Senate?
So that's not squarely on the topic of the dollar or my presentation, but I'm happy to reflect on it. I do think that there are some things that around which a bipartisan consensus can be built with leadership from Secretary Yellen and President Biden, like significant infrastructure initiatives, which would have the benefit of providing the fiscal stimulus that the economy needs and address the infrastructure, very real infrastructure problems that the economy has. So the Republicans and President Trump himself were argued strongly in favor of infrastructure. They just turned out not to be too serious about it and or couldn't get it done. But they're on board with the principle that if interest rates are only 1%, as they are at the moment on Treasury bonds, any productive investment by the government that has a rate of return of more than 1% pays for itself, essentially. And given the state of our airports and roads and rail in the US, I would conjecture there are lots of such investments, and that a Republican-controlled Senate could be convinced of that point as well. If the Republicans in the Senate, on the other hand, simply want to obstruct all progress in order to, quote, prevent President Biden from getting an early win, it's language I heard in another Zoom call yesterday about economic prospects under a Biden presidency, then nothing will get done. So I do worry, and I think we will learn a lot about these issues in the next 2 weeks when the debate about whether we will now have a slim stimulus bill during the interregnum between the election and the inauguration, whether or not that will happen.
Okay, another question from our audience. Given the recent discussion regarding a further stimulus package in the US and yesterday's Treasury moves, what are your opinions on the modern day triffin dilemma?
What are my views of the modern day triffin dilemma? Where your commentator said modern day triffin dilemma, I think he or she was talking about the fiscal version of the triffin dilemma, where on the one hand, the United States is the main provider of safe and liquid assets to the rest of the world, and the rest of the world needs that liquidity for the global economy to continue to operate. So we have to pump out those treasury bonds, but if the US government becomes so indebted that it can't continue to service and redeem on maturity those bonds, then what was formerly a safe asset no longer is a safe asset, and you end up with a problem either way. Either the US doesn't provide sufficient treasury bonds to the rest of the world, or they become unsafe. So I believe in that dilemma in principle, maybe because Robert Triffin was one of my professors way back when. But as I said before, I don't think it's a problem in the short run because interest rates are so low. Debt service as a share of GDP has been going down, even while we've been pumping out those treasury bonds and selling them to the rest of the world big time. if and only if interest rates begin to go up significantly, then I would worry about the modern triffin dilemma in practice as well as in principle.
Mm-hmm. Okay, so a question about the renminbi. What about renminbi being separated from Hong Kong dollar? With increased control of Hong Kong by Beijing, could Hong Kong be moved under the renminbi at some point? Then the weight of renminbi would presumably increase.
Yeah, so Hong Kong is a global financial center. It already does a lot of renminbi related business. So you can open a renminbi denominated bank account in Hong Kong. Historically, an awful lot of dim sum bonds denominated in the currency have been floated in Hong Kong. So that already is an important part of the renminbi internationalization apparatus. But I think the main effect of one country, one system, as opposed to one country, two systems, would be to further raise concerns about checks and balances and the arbitrariness of power that I would argue would do more to diminish the role of the currency than to enhance it.
Mm-hmm. Do you think that China should be aspiring to be a global currency, or do you think they're better off keeping their capital controls?
I think that's a really good point. Why does China want this status? One might step back and ask. There's the national pride argument that every first-class power should have a national flag carrier. It should have an aircraft carrier, and it should have an international currency. I don't think that's a sound argument for promoting currency internationalization. A second reason that some circles in China have promoted renminbi internationalization is to try to force financial reform at home through the back door. That to internationalize the currency, you do have to relax those capital controls. And that exposes Chinese financial institutions to more foreign competition. It forces the pace of domestic financial reform because relaxing capital controls raises the specter of possible capital flight. So that's kind of what happened in 2015, at which point they clamped down again. They tightened the capital controls that they had previously been relaxing. And that's kind of when renminbi internationalization went into reverse. My view is very strongly that forcing the pace of domestic financial reform by opening the capital account is putting the cart before the horse, doing things in the wrong order. Better to get your domestic financial house in order and then to relax the capital controls and then to internationalize the currency. So I would strongly argue against further capital account liberalization with the goal of internationalizing the currency. I would say relax the capital controls, liberalize the capital account in a manner consistent with what you've already done to strengthen your domestic financial markets. So for example, they're now allowing more companies with financial problems to restructure their debts, which is one of the things you need in order to have a well-functioning financial market. There have to be consequences if you incur too much debt or can't service it. So they are moving in the right direction. I just think they need to bear in mind how to sequence the different reforms.
Good. Right, this may be our final question, we'll see. I found a section of your book quite interesting about how China, because they hold a lot of dollars, they have the power to cause financial problems for the US in some way. And I think you said it's not possible because China relies too much on the US to trade. Do you think that in the future, if China becomes less reliant on the US, maybe that power will increase in some way? And you think they're likely to wield that power at all?
China has been gradually diversifying its reserves away from dollars, very gradually. The problem historically had been that to dump its dollars would be shooting itself in the foot. It would, if it began to sell its U.S. Treasury bonds, its own remaining holdings would decline in value, decline in price. You can only sell $3 trillion worth of U.S. Treasury bonds back into the market at a measured pace. So that has been a problem. And there is similarly the danger of some form of U.S. retaliation. So if the two economies were decoupled, that retaliation might be less of a concern. I don't think decoupling is going to happen. So we may not buy 5G technology from China, but I think the two economies remain too interdependent. Anything justifying the world decoupling to occur. And I think it's also revealing that we've just had a massive trade war between the US and China. And they didn't start selling treasury bonds in retaliation for Trump's tariffs. So I think they understand that actions that threaten to destabilize financial markets, like dumping a whole lot of US Treasury bonds into the market, can hurt them as well as hurting us.
Right, okay, we'll definitely finish on this question then. So just to finish off on a general question, do you think it's inevitable that China is going to become a dominant economy in relation to the US, or do you think there's anything the US can do to remain the world leading economy?
So China's population is what, like 4 times the size of US population. So certainly if China can raise its per capita GDP to half of US levels, it's going to be larger in an absolute sense, considerably larger in an absolute sense. What can the United States do about that? The Trump administration had various ideas, none of which made sense, in my view, of how the United States could slow China's technological ascent and prevent them from becoming more adept in various high-tech activities and spheres. They're going to move down that road because they already have the capacity to do so, and then they have the objective of doing so. And with a few exceptions, they don't need our technology in order to continue to progress. They can roll their own. What can the US do? The US can grow its own economy and its own capability more successfully. Also something that the Trump administration had in mind, also something that it didn't obviously achieve. So that kind of brings us back to your earlier question about what Janet Yellen and Joe Biden can accomplish or not. I do think that much of what they have in mind will be not only equity enhancing, but productivity enhancing for the United States. More investment in education and training, more investment in basic science. Those things will help the United States in its competition with China. That competition doesn't have to be a zero-sum game, but problems like this are fixed by starting at home.
Well, thank you very much. That brings us to the end. That was a very fascinating discussion on a very topical issue. So yes, it's been great to have you. Shame it's in this format, but thank you very much. And thank you for everybody for watching and your good questions.
Thank you.